All right, guys, if you believe there's going to be a recession in 2026, just like I do, this video is for you. So in today's video, I'm going to talk about 3 things that I am doing to reduce my portfolio drawdown if we have a recession. Now, guys, I might be wrong. I might be right. We'll see. Now, there is a wide variety of indications that I think there is a recession, from inflation to the tariffs to the back and forth about the interest rate from the current chairman of the Federal Reserve and Donald Trump, and then the new chairman that's going to be taking over Jerome Powell's place in May. So, there's a lot of concerns that are going on in the market. If you look at the market, you see that it has been very choppy, that we have had a few volatile days, well, actually, several on and off volatile days, and it's looking very uncertain. I mean, just the actions of the Federal Reserve Bank and all the countries, I mean, again, very uncertain. So, guys, again, I'm going to talk about 3 ways that I'm going to survive the recession if it happens. Guys, this is not financial advice. This video is for informational purposes, so please do your own due diligence. So let's get to the topic. All right, so firstly, what I'm doing is dollar cost averaging. Okay, I'm dollar cost averaging every 2 weeks. So every time I get my paycheck, I'm going to put a portion of that paycheck into my portfolio. It's more like a pay yourself first deal. And, I do that and then I take care of the bills, right? Because the investment is going to build my future. So with the dollar cost averaging, it's going to reduce my portfolio drawdown anywhere from 25 to 50%. Just depending on, how the market does. And not only that, this is going to reduce my portfolio drawdowns, but it's also going to help me recover faster. So now when the market is fully recovered, I am going to be ahead of the game just because I dollar cost average. All right, so the second thing I'm doing is diversification. Okay, so how am I diversifying? So a lot of my regular viewers know that I am a covered call ETF investor. The majority of my portfolio is in covered call equities. So what I did, I looked for a covered call ETF that has a negative correlation with equities. So basically, if equities are going to go down, then this type of investment is going to go up. So one of the investments that I've made, or changes that I made to my portfolio, I invested in gold covered call ETF. So this is a ticker symbol AIUI. This is by Niels. It is paying a 12% to 12.5% yield. I can't remember off the top of my head. This covered call ETF is a fairly new ETF. It came out in mid-July of 2025, and it has produced a double-digit capital gain, and it's producing a double-digit dividend yield. So it's doing very phenomenal. And the reason why it's doing very phenomenal is because the underlying gold is doing very phenomenal as well. With this type of ETF, just like any of the other covered call ETFs, they do options on the underlying gold. So, if things get really bad and my equities go down and my income from my equities go down, well, my gold covered call ETF is going to go up. So not just capital gains, not just the share price, but my income. So again, it's going to soften the blow on the capital and the income. All right, last but not least, I am thinking long term. And here's why I'm thinking long term. Because if you look at the market history, right? 20, 40, 100 years ago, whatnot, we have had several recessions. We had the Great Depression. We had I think the 1970 recession, the 1987 recession. We had the dot-com bubble. Let's see, we had the 2008 crash. We had the 2020 COVID crash. We had the bear market. And then in the year 2025, beginning of 2025, we had the tariff scare where the market went down 20%. So even though we have had a whole bunch of recessions in bear markets, what happened? It always recovered. And not only that it recovered, but it always reaches an all-time high. So if you have that mindset, so if you stay in the market long enough, right, and you don't panic and you don't sell, and you got to tell yourself this is a phase, then you're going to come out in the positive. You know, if you keep your portfolio long term, then your portfolio is going to be higher than ever before. So like, I'm a cover call ETF investor. So, you know, if I keep dollar cost averaging, and, you know, now I got the gold cover call ETF, and I'm thinking long term, well, guess what? Not only that, my portfolio drawdown will be, I'm not going to say it's bulletproof, but my portfolio drawdown will be reduced, and my portfolio is going to recover drastically. So yeah, so just think long term and just think of it as a phase. And you know what? 20, maybe 20, 30, 40 years down the line, it may happen again. Who knows? But again, it's just a phase, and that's just how you have to see it. And the market's going to correct itself. The economy is going to correct itself. Things are going to go at an all-time high. But I don't know how long it's going to take. It may take 5 years. It may take 10 years. But just know the market's going to recover and go to an all-time high. All right, guys, that's all I have for you. If you guys found this video helpful and informative, please like, share, and subscribe. Guys, thank you for watching, and I will see you guys in the next video.